So we are going to discuss on cash flow statements under International Accounting Standard 7. And the question that we will be doing is a CASNEP question, that is the last sitting, that is December 2025, question number 3 on cash flows. And this is the information which is provided by the examiner, whereby you are told that the following financial statements were extracted from the books of Massey Limited for the year ended 30th September 2025. You are given the Massey Limited appropriation account for the year ended 30th September 2025. You are given profit before tax, corporation tax, profit after tax, where we have the dividend, we have interim and proposed, and retained earnings. Then Massey Limited statement of financial position as at 30th September 2025. So for the statement of financial position, anytime you prepare the cash flow, the examiner will always give you what we call the comparative, meaning you are going to be given the present year and also you are going to be given the previous year. So you compare and you explain any change which arises. So therefore, we have the Massey Limited statement of financial position as at 30th September 2025. You are told that we have the non-current assets, whereby we have freehold land and building, plant and machinery, we have investments, we have goodwill. Then we have the current asset, where we have inventories, trade receivables, short-term investments, cash, and bank balances. Equity and liability, we are given ordinary share capital, share premium, revaluation reserve, revenue reserve, total equity. Non-current liability, we have 15% debentures. Current liabilities, we have trade payables, bank overdraft, proposed dividend, and also we have the taxation. Additional information, number 1, you are told that the revaluation reserve relates to the freehold, land, and building. Depreciation on plant and machinery amounted to shillings 10,350,000 was charged to the statement of profit or loss account during the year ended 30th September 2025. Then number 3, during the year ended 30th September 2025, plant with a net book value of shillings 6,750,000 was sold for shillings 13,230,000. The plant originally cost shillings 27 million. Number 4, you are told during the year ended 30th September 2025, part of the investment was sold at a profit of shillings what? 1.44 million. During the year ended 30th September 2025, impairment of goodwill was shillings what? 3,780,000. The quoted short-term investment are 3 months treasury bills. Then required statement of cash flows in accordance with the International Accounting Standard 7, that is the statement of cash flows. That is what the examiner needs. And in this case, you can decide to use what we call the T accounts to try and explain, or we can use what we call the narration, where we find that the information provided is not that much. We will be using the narration. So we are going to start from the non-current asset. We open the T account and we explain any change or difference. For example, let us start with the first account. We talk about the freehold. Freehold, land and building. Freehold, land and buildings. We talk about freehold, land and building. We open a T account. This is an asset. All assets have a debit balance. So we are going to have the balance brought down on this case, which we are given in the year 2024, 108
Therefore, we have the balance carried down, which we are given how much? 151, 200. Then from there, the examiner had told us if we can go to where we have the revaluation, if we had to open the revaluation account under the equity revaluation. We have the revaluation account. And this revaluation account, we can talk about the balance brought down. We have nothing, and then we are given the balance. Carried down.
We are given the balance carried down of, if we go to the equity revaluation reserve,
we are given 40,500.
That is what we are told. And then in the additional information, number 1, you are told that the revaluation reserve relates to the freehold land and building, meaning
that the land and building was revalued upward. So therefore, we have a revaluation what? We have a revaluation gain. Revaluation gain of how much? Of 40,500. Meaning, this revaluation gain, also you bring it here, we have the revaluation gain, and therefore of 40,500. And if you can look at the revaluation account, you will find that there is nothing more for us to do what? To explain, because the debit and credit side of this revaluation account has balanced in this case. So once you have done that, now what is remaining, I think we don't have any more information about this freehold land. Therefore, let us see whether we purchased more of the freehold land and building. So therefore, in that case, we are going to balance. So therefore, we will take 108,000, then we add 40,500, then we are going to get 148,500, and this is 151. So 151, 200, 151, 200. Therefore, we have what we call the purchase. We have the purchase or what? Or what we call the acquisition. We have the purchase or acquisition of 151, 200. Then we raise the answer. We are going to get an amount of 2,700. So this 2,700 will go to the cash flow statement under what we call the investing what? Investing activities cash flows. Meaning that in this case, you have invested more on what? You have invested more on freehold land and building. So this amount will go to the cash flow statement under investing activities. So the first item is adjusted. Then we go to the next item. The next item is plant and machinery. So this is working 1. Then we have working 2. Then we can talk about working number 3, plant and equipment. Plant and machinery account. Let us open the T account for the plant and machinery. We are going to have the balance brought down in this case, which we are given how much? We are given 57,150. Then we have the balance carried down, which in this case we are given 52,740. Then from there, we are given the depreciation, because remember, this account we have opened it at the net book value. Anytime you open the account at the net book value, the depreciation of that amount of the non-current asset will come in this account. But if we had been given what we call the breakdown, that meaning is the cost and what? The cost and accumulated depreciation, at least we would have opened 2 accounts. But because we don't have the breakdown, we open 1 account at what we call the net book value. So therefore, the depreciation from additional information number 2, we are given a depreciation of 10,350. Then other than the depreciation, when we go to note number 3,
we are told that during the year ended 30th September 2025, plant with a net book value of shillings 50,000 was sold for shillings what? 13 to 30,000. The plant originally costed how much? It originally costed 27 million. So also, we are going to open the disposal, what we call the disposal account. And this disposal account is for the plant. So we open the disposal account. This will be working number 4. And this disposal account, we are given the carrying amount, or what we call the net book value. We are given the carrying amount. Sometimes we call it the carrying amount, or what we call the net book value of how much? We are given a net book value of 67. We are told that during the year ended 30th September 2025, plant with a net book value of 67.50 was sold for shillings what? Was sold. So that's what we call the cash proceeds. We had the cash proceeds of how much? Cash proceeds of 13 to 30. So the reason we are opening this account is for us to see whether we disposed at a gain or loss. We want to see whether we disposed at a gain or loss. So therefore, this will be 13 to 30, and this one is 13 to 30, meaning that there is gain on disposal. We have a gain of how much? The difference. The gain on disposal of how much? Of 13 to 30. Then we subtract 67.50. So therefore we have a gain on disposal of 64.80. 64.80. This amount will go to the operating activities cash flows. We are going to take this amount to the operating activities cash flows, and therefore is a gain on what? On disposal. Then we go back to this account. We have the disposal. And because this account is prepared at what we call the net book value, we need the disposal account, which is the carrying amount, which we are given how much? 67.50. That is what you are going to bring in this case. Any other information about that? I think we are not given more information about that. And if we have no more information about that, then we can balance our account. So we balance our account, we see whether we acquired more plant and what? Plant and machinery. So we are going to have, this is 10,350, then we add 67.50, then we accumulate 52,740, and therefore the total will be 69,840. And here we are going to have 69,840. Therefore, we have the purchase, or what we call acquisition. Purchase, or what we call the acquisition of how much? We acquired more plant and machinery of, we take the answer, we subtract 57,150. Therefore, we are going to have 12,690. 12,690. And in case there is any question, kindly I advise you use the chat, and your question is going to be answered. Then from there, we go to the next non-current item, non-current asset item, and the next one we have is investments. So we are going, this was working 4, we have working what? Working 5, and this working 5, we have what we call the working number 5. We can talk about the next item, which is investing. We have investments account. So you open investment account, this is what you are going to have. Then here we have the balance brought down, because still we are talking about the asset. of how much? We are given 33,750, and then we have the balance carried down, which we are given an amount of 32,400. 32,400. Then from there, we go to the additional information number 4, whereby we are told during the year ended 30th September 2025, part of the investment was sold at a profit of how much? 1440. So we have a profit. We have a profit of 1440, and then from there, let us see whether we have what? We have the amortization of the investment. Let us see whether the investment was amortized. So it is going to be 33. We have 33,750. Then we add 1440. Therefore, we are going to get 35,190. So here we have 35,190. 35,190. Then we have the amortization of how much? Amortization, the difference. So minus 32,400. We are going to have amortization of 27,90. We have amortization of 27,90. Again, this amortization, when we will be preparing the cash flow statement, these will go to the adjustments under operating activities. What? Under operating activities cash flow. Then from there, we are done with working 5. We go to working number 6. And working number 6, we'll be talking about the goodwill. So we have the goodwill account. So we have the goodwill account, and this is our goodwill account. So we are going to have the balance brought down. We are given how much? We are given 26,100. Then we have the balance carried down, which we are given how much? We are given 25,200. Then from there, we had amortization. Is it amortization or impairment? We had impairment, sorry. We had the impairment of goodwill. The goodwill was impaired by 3780. We are given an amount of 3780. That is additional information number 5. We are told during the year ended 30th September 2025, impairment of goodwill was shillings 3.78 million. Then from there, let us see whether there was a new acquisition of the goodwill. We want to balance this account to see whether there was new acquisition of goodwill. So therefore, how much are we going to get? In this case, we will take 3780, then we add 25,200. Therefore, we are going to get 28,980. And also here we have 28,980. Then we have the purchase, or what we call the acquisition. Acquisition of how much? Acquisition, the difference, minus 26,100. So we have acquisition of 28,800. Therefore, this acquisition still will go to the investing activities cash flows, and this impairment will go to the adjustment. The impairment will go to the adjustment of operating activities cash flow. So that's how you are supposed to adjust when we talk about the non-current asset. Whatever that we have presented here is non-current assets. Once we have presented the non-current assets, now we can go to the equity and non-current liability. For the case of the current assets and current liabilities, for those one, we can adjust them in our question. So let us go to the equity. When we go to the equity, what are we given? We have ordinary share capital. So if you look at the ordinary share capital, we start with the ordinary share capital. So we have ordinary share capital. We are given ordinary share capital. And this ordinary share capital at the beginning we are told was how much? If we look at the beginning, we have ordinary share capital of 135 at the beginning, 1,000. Then at the end we are given 162,000, meaning we have issued more shares. We have issued more shares of how much? Let us see the difference. So we have 135,000, then 162,000. So we have a difference of 27,000. So here we have issued more amounting to 27,000. And we have no information which is talking about the ordinary shares, meaning those shares were issued on cash. Above there we have the share premium. We are given the share premium, and we have a share premium of how much? We have a share premium of how much are we given? The share premium at the beginning, it was 67. We are given 67.50. Then it increased. At the end, we had how much? We had 13,500, meaning we had more by how much? It will be 13,500. You subtract 67.50, and we had more of 67.50, meaning we are going to have what? Cash received. Cash received from issue of ordinary shares of how much? We add for the share premium and ordinary share capital. So it is going to be 27,000. Then we add 67.50, and therefore we are going to get 33,750. So the total is amounting to 33,750 in this case. So that's what we have. Then from there, for the revaluation reserve, we were able to explain that. Then from there, for the retained earnings, the reason why we open the retained earnings account is so that we can get what? The dividend paid. So that is what we refer as the revenue what? They have called it revenue reserve account. And for the revenue reserve account, this is what we have. So we have our balance brought down. We are given an amount of how much? The balance brought down, we are given 47,250. Then we have the balance carried down. This is a capital. All capital have a credit balance of 55. Then 300 and what? 350. Then we have the income statement. If we go to the income statement, we can talk about the profit after tax of how much? The profit after tax was 13,500. We had 13,500. Then from there, because we have more information about that, if you look at non-current, if you go to current liability, we are given what we call the proposed what? We have the proposed dividend. So for that case, we are going to do what? We are going to open an account for that. So therefore, let us open an account for the proposed dividend. We have the proposed dividend account. And under proposed dividend account, let us see the balance that we have. The balance brought down. Under current liability, we are given the balance brought down of how much? We have the balance brought down of how much? How much are we given? We go to the current liability, proposed dividend. We have the balance brought down of 3420, and then we have the balance carried down. The balance carried down we have is an amount of 4050. We are given 4050. Then from there, let us see the income statement. So when you go to the income statement, how much are we given as dividends? So let us accumulate. We are given the interim of 1350. Then also we have the proposed of 4050, and therefore the income statement, we have the total dividend of how much? Of 5,400. Then let us see how much was paid in cash. How much was paid in cash? So we get the total for us to get the cash or dividend paid. So it will be 3420. Then we add 5,400. Then we are getting 8820. Here also we get 8820. Then we have the dividend. Dividend paid amounting to how much? So we raise 4050. So therefore here we are going to have 4770. We have 4770 in this case. So this is the dividend paid. So we take this dividend paid, we put them here. We have the dividend paid of 4770, and therefore let us try to balance our account and see how much are we going to get in this case. So when we take 47,250, then we add 13,500, we are going to get an amount of how much? We are getting 59,750. And then let us look at this one. How much are we going to have? It will be 4770. Then from there, 55,350. So we are going to have an amount of how much? We have an amount of 6120, meaning that there is something that we have forgotten. So 59,750. Then minus the answer, we have a difference of how much? A difference of 370. We need to get more information about that 370. So let us see whether we have more information about that for us to be able to balance that account. So that's how you adjust that account for us to get what? For us to be able to get the dividends, for us to be able to get the dividend paid. But the important thing is for us to get the dividend paid. And we have gotten the dividend paid. And then from there, we will look at the revenue account and see whether there was any transfer, or why is our revenue account, or what we call the retained earnings, failing to balance in this case. So we are going to confirm. We are going to confirm why it is not balancing. Anyway, let us continue. After presenting that, we go to the next item. And the next item is what? The next item, under equity, we are done. We go to non-current liability. For non-current liability, we can use what we call narration. And when we use narration, this is what we are told. We are told that we had these 15% what? Debentures. 15% debentures. At the beginning, the debentures were 81,000. Then at the end, they were how much? 67,500. The reason that can make the debentures to decrease at the end of the year is because of repayment. So we have 15% debentures, 15% debentures, repayment. Repayment. How much was paid is the difference. The difference is the amount which was settled or paid. Therefore, it will be 81,000. Then you raise 67,500. Therefore, the amount which was settled, 13,500. We had settled an amount of 13,500. We had settled an amount of 13,500. Once we have presented that, now I think all the adjustments are done. Apart from what? Apart from, I can see we have taxation. Then, other than the taxation, what else? We have the bank overdraft. Then from there, we can also narrate the taxation. So let us talk about the taxation. We see how much was paid. So taxation at the beginning, we had how much? At the beginning, we had 5,400. Then at the end, we had how much? At the end, we had, at the beginning, we had 5,400. Then we add the income tax from the appropriation account, which we are given how much? Income tax, we are given 8,100. Then we compare with what we have at the end. At the end, we have how much? So at the end, we are given an amount of 7380. 7380. We have 7380, meaning that our taxation, let us get the tax paid. Tax paid. If you find that the credit side is more than what? More than the debit, it means that there was a tax paid of how much? If we take 5,400 plus 8,100, then we minus 7380, it means there was a tax paid of how much? Of 6120. That presents a tax paid. Still, you can open an account. And because we are doing the first illustration, let us open the taxation income tax account. We call it income tax account for you to get the better explanation. So this is what we have. We have the balance brought down. It was 5,400. Then we had the balance carried down, which was an 81. Sorry, not 81. It was 7380. Then from the income statement, we had corporation tax of how much? Corporation tax of 8,100. Then from there, you will get the total, which was 13,500. 13,500. Therefore, we have the tax paid. Tax paid of how much? This one, 6120. That is how you get the tax paid. That's how you arrive at the tax paid. So once you have adjusted that, the next item for us to adjust will be cash and cash equivalent. So we need cash and cash equivalent. We can use this part. Let us get cash and cash equivalent. Cash and cash equivalent. And this cash and cash equivalent we are going to get for the 2 years. We have 2025, 2024. So if we use this account here, you can see that we have the short-term investment. So we are going to start with the short-term investment. We are given the short-term investment. For 2025, we are given an amount of how much? Of 15. We have an amount of 15,390. For 2024, we are given an amount of 75,60. Then from there, we have cash and bank balances. Cash and bank balances. Cash and bank balances, we are given how much? 1,800. And this one, we are given 3870. That is what we have. Then from there, we have the bank overdraft. So bank overdraft. Bank overdraft, we are given how much? The bank overdraft, we are given an amount of, the first amount we are given is 21,510. And this one we have 58,860. 58,860. Then this liability. Then from there, let us get now our cash and cash what? Equivalent. Our cash and cash equivalent. So we are going to get our cash and cash equivalent of how much? It is about adding and seeing how much we are going to get. So for example, the first one we have is 15,390, then plus 1,800 minus 21,510. Therefore, we are going to get
negative 43.20, meaning it has remained to be an overdraft. Then the other one will be 75.60. Then we add 38.70. Then we minus 58.860. Then again we have an overdraft of 47.430. An overdraft of 47.430. So therefore, once we have presented the workings, then what is remaining is for us to present what we call the cash flow statement. What is remaining is for us to present the cash flow statement. So therefore, I'm going to give you 5 minutes. So you are going to take 5 minutes to look at this account. Then from there, we can take 10 or 15 minutes for us to do what? To present the cash flow statement. We can take 10 to 15 minutes to present the cash flow statement. So 10 to 15 minutes so that we can present the cash flow statement. So therefore, I think we can proceed. We can proceed to present the cash flow statement. We can proceed to present the cash flow statement, and what I'm going to do is that I'm going to pick some notes which we need so that I can clear our board. For example, we need this depreciation, then we need this acquisition,
Then we need this profit here, profit on disposal of investment. Then what else we need in this account? In this account, for this one, also we need the acquisition. We need the acquisition. So therefore, that information, I think that information, we can present it here. So we can present it here, so it will be easier for us to trace it. So we can start with the purchase. We start with the purchase of freeholder. Purchase of freeholder, which we have 2,700. Then from there, we go to plant and machinery. So we have plant and machinery. Again, is the purchase or acquisition. We have an amount of 12,690. Then we had the depreciation. Depreciation, we had an amount of 10,350. 10,350. Then from there we had gain on disposal. Gain on disposal of investment. Gain on disposal of investment. We have an amount of how much? An amount of 1440. 1440. Then from there also we can talk about amortization. We had amortization. This is the amortization of investment. We had an amount of 2,790. Then what else? What else? Then for the revaluation account, in that case, I just wanted to show you how it will balance. Then we have gain on disposal. We have again gain on disposal. Gain on disposal of plant. Gain on disposal of plant of 6480. 6480. Then from there, what else? In this case, we have the also after that we have the cash proceeds on disposal. Cash proceeds. Yeah, we have the cash proceeds. Cash proceeds on disposal. On disposal of plant. Cash proceeds on disposal of plant 13,230. And therefore we can talk about what else? We can talk about acquisition. Acquisition of goodwill. Acquisition of goodwill. Acquisition of goodwill was amounting to 2880. And also we have the impairment. Impairment of goodwill of how much? 3780. I think that information, now we can get the space for us to present our cash flow statement. We can get our space to present our cash flow statement. I think I picked everything from this area, and being that we have picked everything from this area, now it is for us to present what we call the cash flow statement. Cash flow statement under International Accounting Standard 7. Cash flow statement under International Accounting Standard 7. So the name of the company, is Mercy Limited. So we are going to talk about Mercy Limited. So we have Mercy Limited cash flow. Mercy Limited. We are talking about. Let us have this column here. Then we talk about Mercy Limited. Mercy Limited. Then we have the cash flow statement. Cash flow statement for the year. For the year ended. Our year was ending when? Our year for this company was ending on 30th September. So therefore, 30th September 2025. That will be the heading. Then from there we present. So the shillings, the examiner has given the shillings in what? The examiner has given the shillings in thousands. The shillings in thousand. So we start with
operating, we talk about operating activities, cash flows. We have operating activities cash flow, and under operating activities cash flows, we are going to start with what? Profit. We have the profit before tax. Profit before tax, which was given how much? 21,600. Then we have the adjustments. We talk about the adjustments, and in this case, the adjustments we have, one is the depreciation. We add back depreciation. Remember, in the income statement, the depreciation was subtracted as an expense. Now we add it back, and we are given an amount of how much? An amount of 10,350. So 10,350, we add it back. Then from the depreciation, we had, we can talk about amortization. We had the amortization. We add it back. Amortization of investment. How much? 2790. Then from there, we had the impairment. We talk about the impairment of goodwill. Which was an amount of how much? The impairment of goodwill was an amount of 3780. We had 3780. We add back. Then from there, we have gain on disposal. We had gain on disposal. And this gain on disposal, first of all, we had disposed what? We had disposed the plant, and we had a gain on disposal of plant of how much? Of 6480. You subtract, and also we had investment. And for the investment is here. We had 1440. Then you subtract also from that case. So once you have that, then from there, next is the working capital. Working capital changes. We had working capital changes. And these working capital changes, let us go to the current assets and current liability. We go to the current asset and current liability. When we go to the current asset and current liability, what are we given? Current asset and current liability, we have inventory. We start with inventory. Inventory at the beginning, we are given an amount of how much? Of 78,300. Then at the end, we have inventory of 9450. We have 9450, meaning it has increased. And if if inventory increases, it means we have acquired more or we have purchased more. So 78,300 minus 90,450. So we have acquired more of 12,150. We have 12,150. We have acquired more of 12,150. Then from there, once we have acquired more of 12,150, then we go to what? Then we go to the next one. The next one is trade receivable. We have trade receivables. Trade receivables at the beginning, you can see we had 70,200. At the end, we have 260, meaning that our receivables have decreased. And the reason why the receivables can decrease is because those who purchased on credit now are paying us their debt. So therefore, they have decreased by how much? 70,200 minus 55,260. So we have gotten an inflow of 14,940. This one we purchased more,
it's a cash outflow. This one, the debtors are paying, it's a cash inflow. Then we go straight away to the liability, trade payables. Trade payables, and when we go to the trade payables, at the beginning we had 47 to 50. Then at the end we had what? At the end we had an amount of 52,650, meaning the trade payables increased. So also we are purchasing on credit. We are not paying the suppliers. By how much? Let us see. So it will be 47 to 50, then 52,650. So we are retaining money to do other businesses. 5,400. That is an inflow. Then from there, you are going to get what we call the gross operating what? Cash flow, gross operating cash flow. Then from there, you raise what? You raise the tax paid. The tax paid, how much was paid? How much was paid? We have the tax paid here of an amount of 6120. Then if we had the interest, also you need to raise the interest what? Interest paid. But I did not see whether we had the interest paid. Then from there we will get the net operating cash flow. And we are going to get the net operating cash flow. Then we call it A. Then once we call that A, we go to B. B is about the investing. We talk about investing activities. You have investing activities, cash flows. Investing activities, cash flows. And when we talk about the investing activities, cash flows, we go to the investing activities, cash flows. And for the investing activities, cash flows, what do we have? What do we have for the investing activities cash flows? Number one, we had the purchase. We start with the purchase, and for the purchase, we purchased what? The first one is freehold land and building. We had freehold land and building. Freehold land and building. We purchased an amount of how much? We have it there, 2,700. Then, other than freehold land and building, we purchased plant and machinery. Plant and machinery, we purchased an amount of how much? Of 12,690. We had it in the account. Other than that, also we had what? We had acquired the goodwill. So we talk about the goodwill, and the goodwill was an amount of how much? Goodwill was an amount of 2,880. Other than that, what else? Then other than that, we had the cash proceeds on disposal. Let us talk about the cash proceeds on disposal. Cash proceeds on disposal. Also, what do we dispose? We disposed a plant. And once we disposed a plant, we got cash proceeds on disposal of plant of how much? Of 13 to 30. Remember, for the acquisition, we are purchasing, therefore it is an outflow. Then the cash proceeds on disposal, it means we are doing what? We are selling, and therefore we are getting some money. And also we sold what? Investment. And for the investments, we had a cash proceeds of how much? For the investments, let me see that notes of the investment so that we can see what the examiner was talking about for the investment. So for the investment, you are told that during the year ended the 30th September 2025, part of the investment was sold, or we sold at 1440.
was sold at a profit. So they were talking about the profit. So therefore, therefore this cannot qualify to be amortization. It will be qualified to be the cash proceeds on disposal. So therefore, we don't have this item. This will be the cash proceeds on disposal of investment of 2790. So therefore, when we go to our disposal account, we are going to remove this because the examiner talked about what they had disposed. So that will be cash proceeds on what? On disposal. Therefore, we have the cash proceeds on disposal where it is. Is it here? This is what we refer as cash proceeds. Cash proceeds on disposal. Disposal of investment. We disposed investment, therefore that qualifies to be a cash proceeds on disposal. Then other than that, what else do we have from our information? I think we have picked almost everything in that case. In that case, I'm hopeful that we have picked almost everything, and if that is the case, in here we are going to get what we call the net investing. Net investing cash flow. Net investing cash flow. You are going to get the net investing cash flow. So once you get the net investing cash flow, we call it B. And then finally, now you go to what? Now you go to the financing activities cash flows. And we have this information, we have this one. Then from there, we can go to the financing. So let us go to the financing activities cash flows. Financing activities cash flows. So financing activities cash flow, we can present it here. So we have the financing activities cash flows. Financing activities cash flows. And for the financing activities cash flows, we start with cash received. We have cash received from issue of what? Of ordinary shares. Ordinary shares. We received how much? 33,750. Then from there, we go to the next one. The next one was the dividend. Dividend paid. We paid a dividend of how much? We paid a dividend of, where was this account? The proposed dividend paid was an amount of 47,700. But here we had what? We talk about the dividends. How much did we have as the dividend? It wasn't 47. The dividend, the total dividends in the income statement was an amount of 5,400. Then from there, if we balance our account, I think that our account is going to balance in this case. Let us try 5,400 plus 55, 350. Then we are going to get an amount of how much? We are getting an amount of 6750, and this one we will get an amount of how much? Let us see, 47. We have 47,250. Then we add 13,500. Yes, here we will get 6750. So that's how this account was balancing. The dividend here are the dividends in the income statement. Then we proceed with this. We had the dividend paid. This is what was paid. This was what was declared, the full amount. So they never paid the full amount. Then we had 15% what? Debentures. 15% debentures repayment. Repayment, we paid an amount of how much? We paid an amount of 13,500, and these are outflows. Then from there, we had what else? I think we are done. We are done. That is the financing activities, cash flows. That's about the financing activities, cash flow. Then once we are done, we are going to get what we call the net financing. We have the net financing cash flow, net financing cash flow, and we are going to have the net financing cash flow of how much? Net financing cash flow of how much? Let us see. It's all about adding, because this will be our C. Let us start from the top and see how much we are going to get. So we have 21,600 plus 10,350. Then we add 3780. Then from there we less 6480. Then we less 1440. Therefore, we are going to have 27,810. Then from there we less 12,150. Then from there we add 14,940. Then we add 5,400. Then we are going to get an amount of 36,000. Then we less 6120. We have an amount of 29,880. So we have 29,880. We call it A. Then we go to the next one. The next one, this is what we have. We have an amount of minus 2,700, minus 12,690, then minus 2880, then from there plus 13,230, then plus 2,790. We have an amount of 2,250. We are going to have 2,250, which is a negative. We call it B. Then we come to this one. For this one, we have an amount of 33,750. Then minus what? 47,70. Then minus 13,500. We have an amount of 15,480. We have an amount of 15,480. That is what we have. That is what we have. So once we have that, now we can get what we call the cash and what? Cash and the cash equivalent. So let us get cash and cash equivalent. We get cash and cash equivalent. Cash and cash equivalent. And this cash and cash equivalent will be given by A plus B plus C. We are going to get it by taking A plus B plus what? Plus C. A plus B plus C. So therefore, we have A. This is what we have. A, we have 29,880. Then minus what? 2,250 minus 2,250. Then from there, plus 15,480. 15,480. Therefore, we are going to get how much? We are going to get an amount of 43,500. 110. We have an amount of 110. Then once we have 110, then we are going to add, cash and cash equivalent, balance brought down. And the balance brought down is whatever we have here, whatever that we had computed there. So here we have 47, 30, 47, sorry, not 30, it is 47 for 30. So we subtract, and therefore they must reconcile with what? Cash and cash equivalent. They must reconcile with the cash and cash equivalent balance carried down. The cash and cash equivalent balance carried down. Let us see. Take this plus this. So minus 47 for 30. Therefore, you are getting 4320, which is the same as the figure that we have here. So that's about the cash flow statement. This is how you should present your cash flow statement. And in this case, you have reconciled. You can see that when we take the cash and cash equivalent, that is A plus B plus C, we are getting this amount. Then we have cash and cash equivalent balance brought down, which is the one that we computed here. They must reconcile with cash and cash equivalent balance carried down, which is the one also we computed in this case. Remember, we said that for this cash and cash equivalent is made up of short-term investment. We have cash and bank balances and also the bank overdraft. Then you put them together. Then whatever that you will get is what we refer as cash and cash equivalent. Cash and cash equivalent. So that's all about the cash flow statement. And I think with that presentation, hope you have been able to get one or two items. In case there is any question, you can raise it in the group, or you can reach me later on for more explanation on the cash flow statement. So we will do another question in our next lesson. So I wish you a good day. Until then.
Okay, we can explain more on cash and cash equivalent. I can see that there is a clarification sought, cash and cash equivalent. So we want to explain more on cash and cash equivalent, cash and cash equivalent. So the cash and cash equivalent is made up of, we can say three items. One is what we call the short-term investment. When we talk about the short-term investment, are always part and parcel of what? Cash and cash equivalent. Then we have the cash. This cash can be either cash in hand, and also we have the cash in bank, cash at bank. And or sometimes we can have cash and bank balances put together. And also we have what we call the bank overdraft. So for you to get to what we call the cash and cash equivalent is made up of three items. That is the short-term investment. Remember, this is a financial asset, which is a short-term financial asset. Then we have cash and bank balances, and then we have a bank overdraft. So therefore, for you to get the total cash and cash equivalent, anytime you are not given, sometimes the examiner will give you direct cash and cash equivalent, but anytime you are not given, you will be taking the short-term investment if they are available, cash in hand if it's available, cash at bank if they are available, then you will be raising what? The bank overdraft. So for the year 2024, these are the amounts which were available for short-term investment. We had cash and bank balances, and also we had the bank overdraft. When you add all of them, still you are going to remain with a negative figure, which this negative figure is like the bank overdraft. This negative figure, it means it's a bank overdraft. So our cash and cash equivalent is a bank overdraft of how much? Of 47,430. And when we go to the current year, 2025, again, our cash and cash equivalent, after accumulating all of them, we are getting what? We are still getting a bank overdraft of 4320. So that's how you get it. You are going to accumulate. You just add them. Remember, the bank overdraft is a liability, and these ones are assets. So therefore, the net output that you will be getting can either be positive or what? Or a negative. Like in this case, for the both 2 years, we are getting what? A negative. And that is a bank what? Is a bank overdraft. And therefore, if all the adjustments here are correct, when it comes to the cash and cash equivalent, this cash and cash equivalent that you have at our current year of this one, when you add the A plus B plus C, and then you add together with the cash and cash equivalent balance brought down, they must reconcile with the final figure that we have as cash and cash equivalent, So hope that is clear now. If it is not clear, we are going to do one more question. I hope in our next question, it can be more clear in our explanation. So therefore, thank you for that. Until our next lesson. Bye-bye.